let's just jump right into this explainer because today we're breaking down the actual mechanics of wealth building using a really sleek, modern, analytical approach. You know, everyone is always chasing the secret to successful stock investing. But the truth, the most reliable path to lasting wealth doesn't require a crystal ball. It just requires a rock-solid foundation totally rooted in the principles laid out by experts like Pat Dorsey in his book, The 5 Rules for Successful Stock Investing. So let's unpack exactly how you can build that foundation for yourself. Right out of the gate, we have to ask a question that kind of challenges our most basic assumptions. Are you investing or just gambling? Because a lot of people think successful investing means picking hot, flashy stocks and perfectly timing the market. But the reality is that true wealth creation relies on, well, boring, proven rules and a really deep understanding of business fundamentals. If you're just blindly throwing money at whatever the latest trend is without doing your homework, you aren't investing. You're gambling. Plain and simple.
Okay, here's our roadmap for today's masterclass. We're going to cover 1. The mindset of wealth. 2. Mistakes that destroy returns. 3. Finding the economic moat. 4. The language of finance. 5. Evaluating great management. And finally, 6. The intelligent investor.
Section 1. The mindset of wealth. We're starting with the internal game here, because your behavior actually matters far more than any individual stock pick. The most consistently cited factor in long-term success isn't your ability to predict the future, it's your ability to remain disciplined. Think about time in the market versus timing the market. This comparison shows exactly why consistency wins out. Trying to predict the absolute perfect moment to buy or sell is incredibly difficult, even for seasoned Wall Street professionals. Missing just a handful of the market's absolute best days historically can seriously drag down your long-term returns. But by staying invested through the ups and downs, you're allowing your money to experience steady, reliable compound growth rather than just subjecting your whole portfolio to erratic, emotionally driven guessing. Ultimately, a boring, consistent approach is your absolute best defense. You have to diversify across different companies and sectors so one single bad outcome doesn't tank your whole plan. You've also got to watch out for fees, because even a tiny percentage difference literally eats away at your returns over decades. You should be investing a fixed amount on a regular schedule, dollar cost averaging, right? To just remove the pressure of guessing the perfect moment. And above all else, you have to maintain emotional discipline. Don't panic sell during a dip, and don't go chasing whatever happens to be hyped up that week.
Section 2. Mistakes that destroy returns. Let's look at how a lack of discipline can completely sabotage your journey. Because even if you know the rules, falling into these common traps can quietly but surely erode your wealth.
Out of all these traps, there's one that really stands out to me. Believing the phrase, "this time is different." I mean, look back at the early 2000s dot-com bubble. So many people believed the old rules of valuation just didn't apply anymore, only to watch the markets completely collapse when reality set back in. There's also the huge danger of falling in love with the product. Just because you absolutely love a company's new gadget, that doesn't automatically mean it's a smart investment. You have to invest with your head, not your heart. This is exactly why we must base decisions on rational analysis, look past the hype, and focus strictly on the underlying fundamentals. Section 3. Finding the economic moat. Now that your mindset is bulletproof, let's pivot over to the actual mechanics of picking businesses, starting with Pat Dorsey's golden rule. Think of a company like a giant medieval castle. The economic moat is its defense system. It's that totally unique advantage, whether that's an insanely trusted brand, a powerful network effect, or just a massive structural cost advantage that basically keeps competitors from storming the gates and stealing their market share. Finding companies with wide, deep moats is the true heart of intelligent long-term investing, because these are the businesses that are genuinely positioned to survive and thrive for decades to come. So let's break this down into 4 simple steps to figure out if that competitive edge is actually built to last. First, you assess profitability. How much cash does the company generate compared to its peers? Because higher returns usually signal way more efficient operations. Second, identify the exact source of the moat. Why can't competitors just swoop in and steal their customers? Third, and this is crucial, determine if that advantage will actually survive 5 or 10 years into the future. It's not enough to just have an edge today. It has to be durable. And finally, analyze the overall health of the industry itself. Are sales trending up? How cutthroat is the competition? Section 4. The language of finance. To really analyze that moat we just talked about, you don't need some fancy advanced finance degree, but you absolutely must understand the basic language of investing. Getting comfortable with the 3 foundational financial statements reveals so much. The balance sheet gives you a snapshot of what a company owns and owes at a very specific moment. The income statement tells you how much money they made and lost over a given year.
But the cash flow statement, that is the absolute lifeblood of the business. You see, a company can look highly profitable on its income statement while it's secretly bleeding dry on the cash flow statement. Why? Because profits recorded on an income statement do not always equal real, tangible cash in the bank.
Let me give you a really relatable scenario to highlight why just reading sales figures is so dangerous. Imagine Colgate sells $1,000 of toothpaste to Joe's corner store and gives Joe 60 days to pay the invoice. On the income statement, boom, that $1,000 is immediately recorded as revenue. But if you flip over to the cash flow statement, literally zero cash has changed hands yet. If Joe never pays his bill, that revenue never becomes the actual cash the business needs to keep the lights on. Real financial strength always lies in actual cash in hand, not just reported sales figures.
Section 5. Evaluating Great Management. Okay, so we move to our next crucial stage, evaluating the people actually running the show. You want to make sure the managers are acting like true owners.
You want managers treating the company's money as if it were their own, not just acting like employees collecting a massive paycheck. At the end of the day, trustworthy management comes down to transparency and ethics. You have to check the proxy statement to make sure executives aren't just paying themselves wildly excessive salaries compared to their peers. You've got to look for red flags in character, too. Like, are family members sitting on the board or getting lucrative company contracts? And operationally, when things go wrong, because they always do they acknowledge the issues openly and fix them, or do they try to hide the problems behind vague PR promises?
Look at this historical case study. It proves exactly why you have to watch what managers actually do, rather than just listening to their optimistic earnings calls. Back in the late 90s, Lucent's income looked absolutely incredible on paper. We're talking around $3.5 billion. But behind the scenes, customers were taking way longer to pay, and unsold inventory was just piling up in warehouses. Management completely ignored these massive liquidity risks. Their total mishandling of cash flow led to serious trouble. It just goes to show that operational competence is non-negotiable.
And here's another massive red flag. By the end of 2002, AMD was carrying nearly $1.9 billion in debt and facing incredibly weak cash flow. Yet, despite all that, the CEO was still drawing a massive $1 million salary, and other top executives were heavily compensated as well. This level of executive pay was severely misaligned with the company's extremely shaky financial foundation. It's a classic warning sign suggesting management was prioritizing their own pockets way above the shareholders' best interests.
Section 6. The Intelligent Investor. All right, let's bring this all together. You've got the right mindset, you found a wide economic moat, and you've verified the management is rock solid. Now, we have to look at valuation.
Because we have to ensure we never overpay for a stock. Before buying, you absolutely must know a stock's intrinsic value. This is its true, actual worth, completely separate from whatever price tag happens to be flashing on the stock ticker that day. Because a dollar earned in the future is worth slightly less than a dollar you can invest today, this calculation focuses on the present value of the cash the business will generate down the road. Understanding this one metric ensures you stay anchored to the economic reality of the business rather than getting totally swept up in market hype.
Let me give you an example. The story of Coca-Cola in the 1990s perfectly illustrates that even a stellar company with a massive economic moat can be a terrible investment if you buy it at the wrong price. Coke was a phenomenal business back then, but investors who paid an astronomically high price for it ended up severely disappointed by their returns over the next decade. Why? Because they completely forgot to anchor their decisions in rational valuation. So, to prevent a disaster like overpaying for a great company, you have to demand a margin of safety. This is essentially a structural cushion built right into your purchase price. It protects you if the company hits some unexpected roadblock, or honestly, if your own calculations about their future growth were just a bit too optimistic.
By aiming for a discount of around 20 to 30% below a company's intrinsic value, you give yourself the ultimate protection against unexpected market downturns. It ensures you aren't paying for perfection, and more importantly, it maximizes your potential returns while actively minimizing your downside risk.
I want to leave you with this really provocative thought drawn directly from Pat Dorsey's framework. Without understanding how to manage risk, investing becomes nothing more than gambling. So ask yourself, are you doing the necessary research to combine emotional discipline with rigorous fundamental analysis? Are you actually digging into the cash flow statements, evaluating the management team's character, and demanding a strict margin of safety? Or are you just playing the lottery with your hard-earned wealth? The choice and the resulting financial future is entirely yours.